In 2008, one of the biggest names in global finance, Lehman Brothers, collapsed in an event that would change the world forever. The fallout from this moment still echoes in the financial world today. But what led to the fall of Lehman Brothers, and how did it set the stage for a global economic disaster? Lehman Brothers was founded in 1850 by German immigrant Henry Lehman in the small town of Montgomery, Alabama. It started as a dry goods store, selling everyday items like clothing and tools. However, as the years passed, the company shifted its focus from selling goods to finance, in response to the growing need for financial services. In the early 1900s, Lehman Brothers moved its operations to New York City, where it began to evolve into an investment bank. The company started helping businesses raise money by selling stocks and bonds, becoming a trusted advisor for companies seeking expansion or mergers with others. Over time, Lehman Brothers became known for its expertise in finance and investment management, and its successes on Wall Street began to grow. In the early 2000s, the housing market in the United States experienced a massive surge. This was a time when home prices were rising rapidly, and it seemed like everyone wanted to buy a home. Banks and lenders were eager to give out loans even to those without the best credit scores. These loans were called subprime mortgages, loans given to people who might struggle to repay them. At first, it seemed like a good idea. Lenders were making money by providing loans, and home buyers were excited to become homeowners. The demand for homes was high, and prices continued to rise. People were borrowing more and more money, and many believed that home values would keep rising forever. Banks, including Lehman Brothers, saw an opportunity to make big profits. They started buying risky home loans, which were bundled into financial products called mortgage-backed securities. These securities were then sold to investors who believed they were a safe and profitable investment. In fact, many thought that as long as people kept buying homes and home prices kept rising, the value of these securities would only increase. For a while, everything was working. The housing market kept growing, and banks were making huge profits. But this rapid growth also meant the system was becoming more fragile. As more people took out loans they couldn't afford, and home prices reached unrealistic levels, the foundations of the housing market began to crack. What seemed like a boom was actually a bubble, built on the belief that home prices would never fall. By 2007, cracks began to appear in the once booming housing market. Home prices, which had been rising for years, started to fall. As prices dropped, many homeowners found themselves in a tough situation. At the same time, many people who had taken out subprime mortgages began to default on their payments. As a result, banks and lenders were forced to foreclose on homes, meaning they took back the properties because owners couldn't pay their loans. The more homes that were foreclosed upon, the more the supply of homes increased, causing prices to fall even further. This created a vicious cycle. As home prices continued to decline, the value of mortgage-backed securities also dropped. These securities, in which Lehman Brothers and other banks had invested heavily, were now worth far less than before. Lehman Brothers was in deep trouble. They had invested billions in risky mortgage-backed securities, which were rapidly losing value. Additionally, they had borrowed large sums of money for their investments. As their assets declined, they couldn't pay back their loans, putting them at risk of failure. The housing market was collapsing, and so were the banks that had invested heavily in it. By 2008, Lehman Brothers' financial troubles were so severe they couldn't be ignored. The bank was desperate for a lifeline. Rumors were circulating that Lehman would either be sold or bailed out, but time was running out. The U.S. government had stepped in earlier that year to assist Bear Stearns, but Lehman wasn't as lucky. The company sought help from other financial institutions, including Barclays and Bank of America, but no one was willing to take on Lehman's heavy debt and risk. In the final days before the collapse, Lehman's leadership worked around the clock to secure a bailout or a buyer. Despite intense negotiations, no deal was made. The U.S. government, which had already stepped in to help other banks, decided not to offer assistance to Lehman, fearing it would set a bad precedent for future bailouts. On September 15, 2008, Lehman Brothers officially filed for bankruptcy. The company, once a powerful force in global finance, was now gone. The bankruptcy was the largest in U.S. history, with nearly $639 billion in debt. This news sent shockwaves through the financial world, and its effects were felt worldwide. The stock market plummeted, and fears spread throughout the economy as people realized that Lehman's collapse marked the beginning of a massive financial crisis. The collapse of Lehman Brothers in September 2008 had immediate and far-reaching effects on the global financial system. Lehman's bankruptcy sent shockwaves through the markets, creating fear and uncertainty. Investors, driven by the worst fears, began selling off their holdings, causing stock markets around the world to crash. A sudden loss of confidence in financial institutions triggered a global wave of selling, and many major banks and companies saw massive drops in their stock prices. Since Lehman Brothers was one of the largest investment banks in the world, its failure set off a chain reaction. Other financial institutions that had close ties to Lehman or had invested in the same risky securities also suffered significant financial losses. Many banks found themselves in severe trouble, with some on the brink of bankruptcy. Credit markets, which are essential for businesses and consumers to borrow money, froze almost overnight. Banks became fearful of lending to one another because they weren't sure which institutions were strong. This led to a shortage of credit, making it difficult for businesses to operate and for consumers to obtain loans for mortgages, cars, or other purchases. This slowdown in economic activity led to rising unemployment. Governments around the world quickly recognized that the financial system was in crisis. In the U.S., the federal government took steps to stabilize the economy. The Federal Reserve and the Treasury bailed out other major financial institutions to prevent further inflation and increase the money supply in the banking system. Other countries, such as the UK and Japan, also took emergency measures to protect their financial systems. Despite these efforts, the damage had already been done. The global economy entered a severe recession, resulting in millions of people losing their jobs, homes, and savings. The effects of Lehman Brothers' bankruptcy were felt in nearly every corner of the world, from Wall Street to Main Street. It was a stark reminder of how interconnected the global financial system is, and how the failure of one major institution can have far-reaching consequences for the global economy. The financial crisis exposed the dangers of deregulation, excessive risk-taking, and the lack of accountability in the banking system. In response, the U.S. passed the Dodd-Frank Act in 2010, aimed at preventing another financial crisis by imposing stricter regulations on banks and financial institutions.